Okay, we're going to commence this meeting on Monday, November 20, 2023 at approximately 10 a.m. of the Board of Trustees of the K through 12 Mental Health Trust Fund. Welcome to the meeting today. I'm David Lillard, Tennessee State Treasurer, and I'm Chair of the Board. And we have Secretary Hargett here, Comptroller Mumpower, and Commissioner Bryson here as other members of the board today. The first thing we're going to do is, after taking the roll, which I just did, we're going to approve the minutes, item number 3 from June 14, 2022. Do we have a motion with respect to the minutes?
So moved.
All right, we have a motion. Is there a second?
Second.
All right, we have a second. Any discussion? All right, seeing none, all those in favor signify by saying aye. Aye. Those opposed, no. The ayes have it, and the minutes are approved. Let's see. Probably what we ought to do here is change the agenda order just a little bit to make things flow a little differently, in the sense that let's go to item, with the board's approval, let's go to the item number 6, the financial overview by Brian Derrick, Director of Accounting for the Treasury Department. Would you start us off, Brian? And then we'll go to the investment overview next, and then finally the program overview from Commissioner Williams.
Thank you, Mr. Chairman. Brian Derrick, Director of Accounting, Tennessee Treasury Department. What I have here today is the K through 12 Mental Health Endowment Trust financial statements in draft. They're presently in the hands of our professional folks at the Comptroller's Office being audited. I'll walk through those statements and then talk a little bit about investments and investment accounting in the government environment. Starting with the balance sheet at June 30, 2023, cash and cash equivalents, $14.4 million in cash. We have receivables. This is our investment income receivable that is due at June 30 but not yet received, nearly $3 million. And then you have investments at fair value, and I'll talk a little bit more about fair value in a minute. You have government and corporate securities, total investments, $229 million for total assets of $246.5 million. We have no liabilities at present. According to the statute, at present, the non-spendable corpus of the trust, $225 million. The restricted reserve is at $21.5 million, with total fund balance $246.5, as stated earlier. No questions. I'll move on to the income statement, or the statement of changes. At the top, revenues. This is an investment loss. Investments are the primary revenues. And this is a negative revenue, $6.2 million. And I'm going to talk a little bit about that number here in just a bit, but I'm going to go ahead and go through the statements. Administrative cost is our only expenditure. This is a basis point fee we charge to defray the cost of investing, accounting, legal, and IT work. Giving us a change in the fund balance from the prior year of nearly $6.5 million. You can see the fund balance beginning of the year is $253 and end of the year $246. Any questions on those numbers? If not, I typically would not read the notes to the financial statements, but I do mention they're an integral part to the financial statements themselves. However, today I'll diverge a little bit from my historic practice, and I do want to read through, or just a piece. Our financial statement notes describe how we account for things, and on page 1 of our notes, paragraph 4, we talk about the method used to value investments, and it defines fair value. As securities traded on a national exchange are valued at the last reported sales price. Investment income consists of realized and unrealized appreciation or depreciation in the fair value of investments. Also includes interest and any dividend income. And then the first sentence of the next paragraph kind of puts everything in perspective for us. The fair value of those assets at June 30 represents the price that would be received to sell an asset in an orderly transaction between market participants. In other words, the price, the fair value. And with that, I want to kind of go back and talk about the $6 million loss. That's a summarized number. The major numbers behind that are $10 million in green dollar cash interest income that we actually received. But there's a $16 million unrealized loss. And the way we get to that is on a daily basis. Government accounting is primarily concerned with cash. We have to provide services and benefits, so government accounting defaults back to and is driven by providing those services, and the primary resource to do that is cash. So we mark to market every day to understand if we had to sell these securities to provide those services or those benefits, what would we receive? And that fair value that we mark every day would be that cash number, the price. Our investment folks would probably explain the market, and I'm sure you gentlemen are aware of the rising interest rates and what that would do to our investments at this point would cause a paper loss. That rising interest rate would result in a $1 million investment on the face being valued at $9 million, so it would be a loss. I would like to point out that on the very first page, we have $14 million in cash. Our ability to provide the cash necessary is there, and so we are able to hold these investments until they mature, therefore not recognizing or realizing that investment loss. When that investment, that $1 million investment matures, we're going to get that $1 million back. So I'll stop there. If there are any questions, I'm happy to talk about any other parts or explain anything
Okay,
else.
well, thank you for that good explanation, Brian, Director Derrick. And I'm going to do something like Brian does. Normally, we wouldn't go into this degree of detail about this. You know, we would skip through the financial statements and go forward. But since there's been so much interest in this fund, we want to make sure everybody understands what's going on here. First of all, we live in the world of governmental accounting as under rules prescribed by the Governmental Accounting Standards Board. GASB is what it's called. And the other part of the world dealing with publicly traded companies and private companies that follow financial accounting, commercial business entities, I like to generally euphemistically describe them, they follow accounting rules that are different in many cases. Sometimes they're the same, but in many cases they're different, prescribed by the Financial Accounting Standards Board, known as FASB. So you probably often heard about the FASB and the GASB. Well, we're under the GASB. And as Director Derrick pointed out, the GASB requires mark-to-market accounting, and that's what he was talking about when he was discussing the fact that when we invested in longer-term securities here that we'll just use for illustration purposes a 10-year duration or something like that generally, then at the point that we invested in them, the market was pretty low in terms of the yield that those securities would generate each year. It subsequently went up because the Federal Reserve, Chairman Jay Powell, our friend, you know, had been telegraphing along about that time period. This was in the spring of 22, I believe, is when we basically started moving that money out of the State Pool Investment Fund, telegraphing that they were going to raise rates in the Fed to fight inflation and do other things. And as a result, rates have gone up tremendously. Well, that means if you're holding a bond that you bought that yields a modest amount of money earlier, back when interest rates were low, and that has a fixed rate to it and all that, that your bond is going to be worth less as those rates, the market rates, keep going up over time. And the difference here is, as Director Derrick very ably pointed out, is that, that's an unrealized loss that you have. And unless you sell your portfolio and thereby lock in the loss, you've actually physically lost money on that equation, then it's a matter of paper is what it amounts to. And our intention is to hold these securities for the long term. Now, at the end of, let's say if it was a 10-year bond that we bought, and we bought a little different instrument, but it's kind of like a 10-year duration, at the end of that period, if interest rates are still high vis-a-vis the rate that our instruments are paying, then basically we will have to make adjusting entries on that final year financial statement that will bring us back to par on the value of our securities. You can look on page 5 or so of the notes that we have here and everything, and as Brian pointed out, investments were valued at $229,174,000 at the time that this was put together for June 30, 2023, and we had $14.415 million of cash and cash equivalents. Even though we have an interest rate that's lower than the market interest rate on these bonds, they are still throwing off cash. They're still earning cash. And so basically to get at the value that he has on the financial statement on page 1 of this, $246,577,000 roughly, you take $250 million that was originally put in and the $229 million mark-to-market value of those securities, adding back the $14.415 million plus another entry for a receivable there, and you get to the $246 million number, which is the value of the trust today. So I hope that makes sense to everybody that, there's no reason to panic about this fund is what my point is, because these are unrealized losses, and we're, the interest rates for a significant period of time were down near zero. It wasn't too long ago that in the Treasury Department, we were very worried about rates going negative, actually. In fact, on the State Pool Investment Fund, our short-term money market fund, where we manage idle state cash and local governments have money in that as well, we got down at the bottom of the yield trough on the low interest rates of yielding only like 3 basis points, 3/100ths of 1%, which when you net a fee against it, that gets you pretty doggone close to zero, So we had that problem for a long, good, significant period of time, and we're working our way out of the trough. The yield curve is inverted. It continues to be inverted today. Short-term securities pay over 5% now, year or less securities, government securities do. And the 10-year Treasury bond, I looked it up this morning, was like at 4.46 or something like that. So, it's still highly inverted, and it's probably, I don't know, Thomas Kim and others who are the fixed income experts of the world could tell you, but, we're probably approaching a modern day record of how long this has been inverted, and everything. So we're going to continue to watch it very closely, and we do this on a daily basis in the Treasury Department. And this fund is $250 million. We're managing probably $20 to $25 billion in fixed income investments every day in the department. So it is an important fund, but it's a smaller one for what we do and everything. But I hope that makes sense to everybody as an explanation. Director, do you have any other comments about the financial statement?
No, sir.
Okay. All right. Okay. Any other questions from board members or anything about this? All right. Seeing none. Let's see anything else on your overview, Brian, here at this point for item 6. Okay. All right. So we'll call on Michael Breakbill, the Chief Investment Officer of the Treasury Department, to give us an investment overview. Sorry if I stole some of your thunder there with what I said.
It's done. Good to see you all. Yeah, there we go. There's my presentation. Michael Brakebill, Chief Investment Officer, Tennessee Treasurer. Very glad to see you all. I actually am very excited about this program and portfolio and what has transpired. I think it's gone pretty well, actually. If you see this chart, what I'm trying to illustrate is the path of interest rates, as the Treasurer mentioned, over this past 2 or 3 year period, and the sequence of events that has transpired in the creation of this fund. On May the 27th, 2021, the bill was signed creating the fund, and just past that, the 10-year Treasury was about 1.25 points. And as the Treasurer mentioned, cash rates were basically zero. In fact, we had several months, as you may all recall, where we charged 3 basis point fee on the State Pool Investment Fund, and investors get the over what is earned above that, and we credited 1 basis point annually returns of the fee. So people were making 1 basis point. So interest rates were virtually zero, as close to zero as you can imagine. After the bill was signed, we went into a portfolio analysis and construction research portion with our partner Veris Advisory. Part of that portfolio research had to entail our constraints, which was it had to be a full fixed income portfolio, the $250 million we mentioned, and then basically we wanted a higher return of cash. At that time, basically cash was zero, so we wanted more than that. And so we put together a portfolio and a path that we have been on where we have one piece of the portfolio, which we call the LPF, or Large Pension Fund, which is basically long duration, high quality fixed income bonds, which is also what is in the pension fund. We have $12 or $14 billion of securities that fit that definition that we have managed successfully for many, many years. And then another piece of the portfolio, which is a low duration, highly credit sensitive part of the portfolio. The view was we would transition from the duration piece to the credit sensitive piece over a period of time, and that's the path we have been on. And kind of a refresher, at that time in late May, June of 2022, we could see we had expectations of a long pension fund return of about 4%, a little less than 4%, with 9.5% annualized risk, which is a decent amount of portfolio risk, and for the whole blended portfolio, an expectation of 4 or 5% and a 10% annualized risk. We took that, we codified that in investment policy, worked through the implications of that, and then met with you again on June the 14th, 2022, where we had our investment policy approved. And you can see about that time, interest rates had moved up. The short-term rates were a bit over 1.5 points at that time. The 10-year around 3.5 or so. So we had an improvement in the rate environment at that time. And we went, subsequent to the board meeting, we went out and did the initial investment of the portfolio into the LPF for the long credit portfolio in the late June 2022. So as we walked into fiscal 2023, the portfolio as a whole was basically fully invested. And you can see as the 10-year rates rose, we have a long duration portfolio that hurts your returns, no doubt about it. And you can see what's happened on the cash side, on the short-term side as well. When we put the portfolio together, and at the portfolio at June 30, 2022, it generated about a 4% annualized yield, which at the time with $250 million would generate about $10 million a year in income. As we walked through the year, this last fiscal year in May, we did an initial transition of about a third of that portfolio into the shorter duration, more credit-sensitive part of the portfolio. And I have a graph right after that that illustrates how that transpired a little bit better. And then here we are at the end of recent period, end of the first quarter of fiscal '24. And the interesting thing is the portfolio total value has decreased a little bit, and yet the yield of the portfolio has increased substantially. So where we started off, this portfolio generating about $10 million a year. Now the portfolio at roughly $42 million in total value should generate about $17 million a year. So the actual income the portfolio generates has risen about 70%. So it actually is pretty pretty interesting and pretty exciting right now. This shows graphically the portfolio implementation, and then also the different pieces of the portfolio, and talks about what their current structure and their current fiscal or investment characteristics are. We started off with all the money in the SPIF, the short-term investment fund, and that's the green bars on the left. Currently, not at the time, but currently, the SPIF yields about 5.4%, and of course, it's a cash portfolio, so it has a very short duration. We moved that money, as I said, in the late June into the investment grade portion of the portfolio, which now has a yield of about 5.3% and almost 10-year duration, so it's got a decent amount of duration risk. And then we did about a third of it transition into our non-rated portfolio, which has a short duration and a lot of credit risk. You pull that all together, and right now the portfolio has a yield of a little above 7%, say 7 conservatively, a duration of about 7, and so it really looks pretty nice right now. If you look through each one of these pieces, they each have different risk levels and risk characteristics. This cash piece, the biggest risk of the cash part of the SPIF is that if you hold assets there for a long time and then the economy weakens substantially, then you have to reinvest those assets at lower levels of interest rates. So the green part, the part that would invest in cash, or is invested in cash, basically the biggest risk is reinvestment risk. The blue part, the investment grade piece, it definitely has duration risk. If the economy slows and interest rates fall, it'll do really, really well. If interest rates stay kind of flat, it's going to do pretty well. If interest rates rise, it won't do so well. The orange part on the top right has credit risk and really not duration risk. So it's more sensitive if the economy softens more and you have kind of spreads widen or more kind of default type of risk. So each one of these different buckets has different risk levels to take into account. And, you know, that's why you put a portfolio together with different things to balance these risks out. Hey, Brian, if you want to go to the next, this is basically kind of our view in the long run, and we can, I put potential because it's not exactly how it has to be, but basically one way we could transition into the long run portfolio is to slowly move the portfolio over to the non-rated piece, and our strategy was for 2/3 of that, or 3/4 of that, to be in that non-rated piece of the portfolio and into that. Let's go ahead and go to the next part. I've been watching, these next two pages I have are graphs that I watch on a basically daily basis to get a sense. Basically, it's a temperature of what market participants think short-term rates are going to do and what's going to happen in the marketplace. The graph on the top, the orange line, is Fed funds futures, or basically what market participants are betting on interest rates. The orange one is for December of 2023. So it's basically how rates will end this year. And then the blue one on the bottom is an expectation for how rates will do at the end of next December. So it's basically kind of looking at Fed funds futures for 2 different periods and seeing how those act. And you can see from the left, and just to back up a sense, what I'm looking for are there's essentially 3 concepts. There were 2 big ones that have been market concepts we've all been following, and then one that's starting to come up, but it's just starting to bubble under the surface. And those three things are, one was, what is the peak level of interest rates? Where are we going to hit? What's the peak? The second question in the marketplace was, what's the duration and how long are interest rates going to stay high? And the third thing that's kind of bubbling up now is, if the economy soften a little bit, how soft it's going to be. So those are kind of the key things, and those are what I look at this thing, one of the things I look at this to see. As you can see over time, both interest rates futures went up dramatically from basically 1.5 up to, the 4.5 level. And then as the Fed kept raising interest rates, they started kind of a gap developed. And the next page I'll show you in a bit is just the gap between these two. And the gap is basically people's expectation of how they should fall in the future. We walked in, and you see the cliff side there. The two cliffs are the failure of Silicon Valley Bank and First Republic Bank. So when the bank crisis hit this last spring, investors looked at that and went, okay, the rate cycle's over. We've created a banking crisis. The Fed's going to have to turn tail right now. And that's what caused that cascade. And then slowly what transpired is the banking crisis that we thought was going to be endemic across the economy didn't really happen. So interest rates kept creeping back up. And then one of the key things, when I said there are three different things, metrics that the market was looking at, the peak rate environment, basically the market, essentially investors' view was they came up with a decision of what that was going to be, and you can tell that where the orange line flattens out and stays flat. Investors are basically like, that's it. The top in rates is here, and that's why that line goes flat to the right. The blue line, as it comes up, means that investors are like, wow, the rates will stay higher than we thought several months ago. So December 2024 rates will slowly creep up. And so that's what you see on the bottom blue graph. And as that thing narrows, that's what that's kind of taking into account. And if you'll show, Brian, if you please, on the next page, you can really see this. This is the difference between those two graphs. And as you move up, so to the right where it's moving upward towards blue, the blue line there is 0. That means that the gap between today's rates and the future 24 rates is narrowing, and the implication is the Fed is not going to cut as much as we thought. And that's what that's mean. Recently, if you notice that little rollover in the short-term rates, what that means is that we're starting to see economic weakness. We got a weak jobs number. We've had a lot of weak survey data. We had an LEI number that came out this morning that was minus 0.8. We've never seen an LEI that has decayed as much as it has over the past year without having a recession. So you see that rolling over, which means people are starting to say, well, maybe they will have to back up and cut rates. So all of that means is that it looks like we're entering a period where it's a much more benign rate environment than we have seen in this past year and a half. And for this portfolio, it should be a lot better environment for that. There are two other documents in your packet. One is the a September 30 performance report from Veris, and it just shows the portfolio pieces, and then it has a trailing 1 year. Trailing 1 year number, it's basically up 1.97% from September 30th, 2022 to date. A key thing is that we transitioned the portfolio. So you can find there. No, different one. That's okay. I'll just talk through it. So, key thing is the portfolio is up a little bit from the trailing year. It is. It's lagged the benchmark pretty substantially, and it's because that orange piece of the portfolio, which we really couldn't implement in a short period of time, did better than the long pension because the spread credit with low duration it definitely performed at a better rate. Finally, just say I have the investment policy in your packet from last year. We do not have any recommendations for any changes or anything at this time. We feel like it makes sense. It's a good document, and we're driving to that. It very well could be that through the course of this year, through changes in the program or expectations, we would want to come back and make some modifications to that and talk to you later at that time. So with that, that's an overview of the implementation of the portfolio, and happy to take any questions and that you may have.
Okay, very good, Michael. Any questions? Michael Brakebill.
Yeah.
All right.
Thank
Thank you
you.
for your great presentation. Commissioner Williams, next item here is program overview from the Department of Mental Health and Substance Abuse.
Thank you so much. This one I just clicked to get it to go through.
Isn't this riveting? It's exciting stuff.
Good morning.
Hello, Commissioner.
It's very good to see you, Chairman, and distinguished members of this committee. To my left is our new Assistant Commissioner, Children and Youth Services, Beth Goodner.
Welcome.
We wanted to make sure that she was able to meet you all today. She just started, so she's getting her feet grounded and getting them wet. Beth, any?
It's nice to meet you all and such an important topic, and really happy to be here today.
Thank you.
Thank you. As you guys know from last time that we met, we talked about the study that we had been legislated to do and move forward as it relates to these dollars and how we would allocate these dollars when they're given to us. So today what we want to do is update you on that K through 12 Mental Health Trust Fund study. It was done by the University of Tennessee School of Social Work. So if you go to that first slide, what you'll see is the project aim, as was in legislation, was to map the mental health resources and services that are available currently for Tennessee K through 12 students with its schools and communities. We were to map the landscape and help inform a strategic approach to filling the gaps and unlocking existing community resources. And then you'll see over here something that we all know is going on in our communities. Youth mental health problems are escalating nationally as well as in Tennessee. Student mental health and well-being we know is strongly associated with academic success. We know that there's an increasing reliance on schools to meet the students' mental health needs, that an increase in mental health problems and strain on resources due to the COVID-19 pandemic has happened, and that Tennessee educators identified the need to increase mental health supports at the local level. How this study was conducted, you'll see that participants were asked about the types of mental health services offered, the familiarity that they had with the specific mental health training opportunities and interventions that exist, talked about schools and community agencies and how to collaborate to provide mental health services, also looked at how data was being used to drive decision making as well as making sure that those were included in the mental health services delivery, looked at barriers to currently providing mental health supports, the gaps in mental health services, as well as the opportunities to expand existing mental health services. If you'll look to the right, you'll see two survey questions from the school survey that went to the principals and the superintendents and to the faculty. What are the limitations or factors that make it difficult for your schools to close the gaps in mental health services and resources? And then for the questions that went to the community agencies service providers, you'll see are there data regarding mental health needs and services shared between your agency and schools in order to inform the services provided and to coordinate care. Those are just two sample questions. Turning to the next slide, you'll see that what they did in this survey is they gave to us and the Department of Education a breakdown of what they'd recommend in three major buckets. The first one was to increase collaboration and coordination of services, and underneath that, you'll note that they're talking about increasing it on the regional and state level, talking about clarifying the roles between what the school counselors are doing and what the community behavioral health providers are doing, clearly communicating all available services, and providing mental health training to all stakeholders. In bucket 2, they focused on increasing capacity from what the survey respondents said. They wanted to increase funding for the local education authorities and community-based mental health providers to expand staffing. They asked for a maximizing of capacity of existing personnel in schools. They asked to provide mental health resources and supports for those LEA faculty and staff, and also asked to create a structure to support the implementation of integrated and comprehensive supports for students and families. When you go to the next slide, you'll see that the third bucket was to expand usage of data to drive decision-making. That's something that our department's already started on. As you know, Commissioner Bryson, we have an Office of Research and Planning, and we already do preliminary outcome research on the services that we provide already in schools. But this talks about being able to collect and analyze outcome across schools' success metrics, and then utilizing that data at the state, regional, and district levels to identify effective intervention strategies and evaluate supports and services. If you'll note on this last slide, as we talked before on the K-12 Mental Health Trust Fund, with that initial investment and the dollars that will come from that, we will issue an announcement of funding for competitive grant awards. We will fund the services, including one-on-one and group mental health interventions for students, mental health training for faculty and staff, and mental health services and supports that extend to families. Grants will be distributed equitably across the state based on population counts and school counts. And when we look at the outcomes, we already see preliminary strong outcomes on the programs that we already fund, and they really equate to increased academic success, reduced truancy, reduced discipline rates, and then increased graduation rates. It is our hope that these dollars would continue to help us expand and be able to continue to help those youth that are struggling across our state and in need of help. That concludes our presentation. Open to any questions that you might have.
Okay, any questions for Commissioner Williams or her staff? All right, seeing none, we appreciate the
Thank you.
great presentation there, and
Thank
thank you for your good work, and
Absolutely,
that your
thank you.
department does as well.
Thank you.
Okay, so we're up to item number 7 on our agenda, which is determination of the funds made available for disbursement in FY 23-24, and the determination of the funds made available for disbursement in FY 24-25. The chair is going to move to make a disbursement available in 23-24. That is the current fiscal year of $6 million. That will be a portion between recurring and non-recurring by the Department of Finance and Administration, but that's the overall amount. And also in addition there too, for the year FY 24-25, another $6 million. That, of course, is subject to appropriation by the General Assembly in the next Appropriations Act that will be proposed by the governor in the wintertime here. All right, that's my motion. Is there a second?
Second.
All right, I have a second. Commissioner, yes, sir.
Thank you. I think you mentioned this in your motion, but I didn't quite catch it. What is there in the motion, is there a distinction between recurring, non-recurring, or did you say that's going to be left up to the Department of
It's up to
F&A?
the Department of Finance. This board doesn't characterize what's recurring and non-recurring,
Right.
so that's up to you guys to do, so.
That's what I assumed. I wanted to make sure. Thank you.
So, from an accounting standpoint, but it's $6 million for each year is what it is, 2 separate amounts. Okay, and any discussion about that? All right, seeing none, we've got a motion and a second and no discussion. All those in favor signify by saying aye. Aye. Those opposed, no. The ayes have it, and that motion is passed for both the years described. Let's see here if there's anything, is there anything else that needs to come before the board today from your standpoint? We have item number 8, which is the opportunity for public comment. The chair would ask if there's a public comment. Yes, ma'am. Yes, come forward. Please state your name, and if you're representing an organization, if you'd state who that is, and you're going to sit, you might want to, you want to sit right there? Is that what you want to do? Just be sure and punch that little button on the left that has the person speaking there. That'll have a red light. It'll come on. Shit, Brian will help you with it there.
On.
Yeah.
Hello. Okay.
All right, there you go.
All righty. Thank you. And thank you for this opportunity and for this very important discussion today. My name is Bernadette Pager, and I am with the Tennessee chapter of Children's Health Defense. Our mission is to end health epidemics by working to eliminate harmful exposures, hold those responsible accountable, and establish safeguards to prevent future harm. One of the harmful exposures impacting children's health today are psychotropic drugs. Those are drugs prescribed to children diagnosed with ADHD, depression, anxiety, and more. Those drugs come with black box warnings for suicidal and homicidal ideation, increased agitation, impaired cognitive ability, aggressive behavior, mania, and a host of other neurological and physical side effects. These drugs have no off-ramps. Getting off of them can be as dangerous as being on them. I have a huge packet of just the first page of many of the drugs that children are put on today. As the Board of Trustees for the K-12 Mental Health Trust Fund, it is your duty to ensure that before you disperse funds, you research to the best of your ability the programs you are funding, looking for unintended consequences, such as increased access to and use of psychotropic drugs with black box warnings. Through a recent Freedom of Information Act request, the Citizens Commission on Human Rights International, a mental health watchdog organization, obtained information from the Tennessee Family and Social Services Administration on how many children are being prescribed psychotropic mind-altering drugs through the state's Medicaid program. The statistics reveal that in 2021, just for kids on Medicaid in Tennessee, there were 94,058 children aged 0 to 17 years who were prescribed psychotropic drugs, which include antidepressants, anti-anxiety drugs, stimulants, antipsychotics, and mood stabilizers. Of these, 11,453 of the children were aged 0 to 5. Again, these numbers don't include any private insurance. Over 1/3 of children in foster care, that's 35%, filled a prescription for psychotropic medication as compared to only 8% of non-foster children in Medicaid. In all the surveys and studies recently done regarding mental health of school children, I am unaware if data was collected on how many children reporting mental health issues were on prescribed psychotropic drugs. But we do know that it is highly likely when children have increased access at school to mental health clinics, the rate of diagnosis will go up and so will prescriptions of black box warning drugs. While we do want to ensure that children struggling with issues get the help they need, we also need to be sure we don't inadvertently increase a major driver of disturbing behaviors. We want to decrease the rate of diagnosis by increasing solutions that address the social, nutritional, environmental, and iatrogenic root causes of mental health issues. Our goal should be to decrease labeled children and increase able children who become able adults. My final point is this. Fiscal due diligence requires we understand the role psychotropic drugs are playing in the current increase of mental health disorders in Tennessee so that we do not inadvertently drive increased use of black box warning drugs and their devastating consequences. Beyond the human cost, the financial burden of psychotropic drug side effects to the state is significant. From increased funding needed in schools to increased use of Medicaid to loss of income when fewer children graduate able to enter the job market. It is imperative that we know how many children are already on these psychotropic drugs when they ask for services. We need to know, have any surveys included asking about the use of black box warning drugs? Are adverse reactions being reported to MedWatch? Before we fund programs, we must know these answers. Otherwise, we will have a fiscal burden like we have with opioids. The human and financial cost is unacceptable, but it is avoidable. Thank you.
Thank you for your comments. Are there any further comments by anyone? All right, seeing none, let the record reflect that we have no further comments. Yes, Secretary.
I would ask, while I'm not espousing to be 100% agreement with everything that was said, I do think she's taken the time to be here, and that that her remarks be entered into the prepared for the minutes whenever we come back for our next meeting.
Sure. All right. Okay. All right. Anything further to come before the board today? If not, the chair would move to adjourn. Is there a second? Second. We have a second. Without objection then, board will stand adjourned. Thank you for your service, and thank you for being here today.